On this episode, Ryan and I talk about debt repayment with the infinite banking concept. Should we wait to get out of debt and then start IBC? Prioritizing your capital, the debt slave construct that we all are born into. And then we talk about the origins of the infinite banking concept and becoming your own banker. Welcome to the Banking with Life podcast. My name is James Neathery. I'm your host.
I'm Ryan Griggs, your co-host.
And today we're going to have a conversation about loans, debt repayment.
Yeah, I get the question, IBC is great. I've read the book, but I've got these outstanding debts. Maybe it's student loan debt, maybe it's mortgage debt, maybe it's a car note, maybe it's student loans, whatever it might be. And, I'm going to pay those off first, and then I'll do IBC. As if the sort of implication is that if you have outstanding debt, then you need to wait. You need to pay the debt off first. It's kind of a hangover. I see it as kind of a hangover from the idea that of the pay cash method, right? We need to pay cash for things. All debt's bad. You need to get rid of it immediately. And that those assumptions sort of go unanalyzed when talking about IBC. But I get that question a lot. I think it's pretty popular.
I think it's more than a hangover. That's a part of the message from typical financial talking heads, gurus, financial entertainers. Get out of debt, get out of debt, get out of debt, so you can start saving money.
Right.
And there's nothing inherently wrong with that. It took a uber lot of discipline to accumulate all that debt, right? So it's okay to practice discipline by getting out of debt. I get that. But if you have discipline and, is there a better way? Could there be a better way? And sure, there can be a better way. And
what stands out to me about and becoming your own banker and how Nelson Nash originally came up with the infinite banking concept, he didn't wait until he'd paid off all his debt until he isolated this idea. In fact, the infinite banking concept as a idea was born in the middle of a substantial amount of outstanding debt to third parties. And Nelson talks about how he owed $500,000 to lenders because he was in the real estate business at 23.5% interest in the 80s, right? And that's when he had the realization that, in fact, his problem, despite the fact that he was already paying substantial life insurance premium, he wasn't paying enough. He realized, as I think we all do at some point, that our need for finance is greater than we thought it was.
Yeah, no question.
Yeah.
Well, granted that his story in the first part of the Becoming Your Own Banker, his first book, if you haven't read it, you should read it. And no question, is almost like a coal under pressure. It takes all that pressure and time to create a diamond. There was, and let me also say that Nelson was being very generous in his book, Becoming Your Own Banker, right? Because he didn't really talk about, he did not write about the $700,000 obligation that he inherited because an attorney defaulted, right, filed bankruptcy. Nelson did not, and he assumed that, but he didn't include that in his story. So he was being generous. And if you let's think this through, that all debt's bad. That's not right. We can get into that, but I've gotta do something. I've got to get out of debt so I can start saving money. Yep. That comes from just typical financial advice. Is it bad advice? No, it's pretty good advice, especially if you do not have discipline and you do not understand cash flows, you do not understand leverage, or you're not comfortable with leverage. But let's talk about debt for a minute. Debt is crushing, right? I mean, it's crushing, being servant, the borrower being servant to the lender. That's biblical. You don't want to be there. You don't want to be that guy.
Sure.
And if you look at what's going on in the big wide world today, though, we're all dang near debt slaves. You're born into it. It's part of the construct, part of the paradigm, and somebody's making a lot of somebodies. A lot of somebodies are making a lot of money off of that construct, right? And so Saks Fifth Avenue, marketing is like, go spend it today, get it today, instant, immediate gratification.
Yep.
Then we use plastic money or digits, and it makes it very easy to, part with really your money.
Right.
In the form of plastic and digits, to have this immediate gratification. And then, by the end of the month, by the end of the year, after taxes, you're looking up and saying, my gosh, there's a lot of debt. I need to do something different.
Mm-hmm.
So yeah, the focus is on debt. So get out of debt, and then I can start doing something else. And I mean, that thought process is part of the construct.
Oh yeah. And as an economist, I think, compared to what? Because
wait, are you waiting for me to finish talking so you could talk, or were you listening?
I was totally listening.
Okay, thank you.
Oh my gosh, get yourself a co-host that will attack you during the podcast. It's really
I love
really
him.
the key to success.
Listen, I love our podcast. I'm not.
I think it's the best financial podcast there is out there.
I agree. I really didn't mean. I'll quit that because I don't want to.
No, but to build off of what you're saying, I think that the reason so many people do think it is a good idea to eliminate whatever outstanding debt they have before switching to something like infinite banking or taking any other kind of financial strategy is, compared to the alternative, which is continued indebtedness and mounting obligations to outside lenders. When that's the alternative, sure, eliminating your obligations to third parties is totally legitimate.
Sure.
I think that the landscape changes, though, when you become aware of what's possible, like Nelson says, and you cite frequently, if you know what's going on, you know what to do. Well, people have to know what's going on first.
Right.
I had a guy, young kid, new client out in New Jersey, and we had exchanged several phone calls, and you kind of see the progression in his thinking, from call to call, and he's really getting it, asking the right questions, so he's catching on, he understands sort of the trajectory that he ought to be aiming for, and then finally, when all the objections are answered and everything, he says, I'm going to try to get the words right, he says, "This is such a bizarre way of thinking, it just so happens to be true." And that's exactly right.
I love that.
It's a bizarre way of thinking compared to what the conventional paradigm is. Right? The conventional, from the perspective of IBC, the conventional paradigm is bizarre. Right? And so in that call, what maybe went on for an hour or so, we finally got down to the end, and I said, what we're kind of talking around here, we're just going to put a label on it, is the idea of prioritizing your own capital. Right? So if you start infinite banking while you still have these outstanding obligations to other third parties, and you're paying substantial premium, right? You're prioritizing your capital. You're choosing to put your savings, your capital, your control over financial value above the owners of the other conventional lenders, right? And most people just aren't doing that. And so when we say, "Oh, I can't do infinite banking because I do have these outstanding obligations, I got to pay them first," mm-hmm. You're prioritizing somebody else's capital. Mm-hmm. And so, no kidding that you stay stuck in whatever economic class you might be in.
You were prioritizing capital to even accumulate incorrectly, or for someone else's
somebody
benefit,
else, yeah,
by accumulating all the debt to begin with.
Yes.
Right.
Yeah.
And then you're just continuing that. So, this is their capital is so valuable to me that I've got to honor all the obligations, and you should honor all your obligations. I'm not saying you shouldn't do that,
right.
But you're prioritizing their capital above yours. You're valuing their money more than yours.
Right.
And
then it's not just your money. That's your family's well-being. It's your future livelihood. It's your ability to deal with whatever might come your way, be it positive or negative. It starts to sound a little perverse when you start to think through it, but I don't think most people do, because they don't know that there's another paradigm that you can switch over to and see things differently. Yeah. Or as this young man thought, in a very bizarre fashion.
Did that bring a tear to your eye watching his progression?
Not that part, but there were tears. I get, and we talk, this is a little off topic, but we get to talk about whatever topics we want, which is the nice part here. But, I get invested emotionally with my people, right? I want them to succeed. Like it's your money, the most emotional topic out there in the world, outside of maybe like love or jealousy, is money. And when you get so bought into it, you want the best for people, and yeah, it can get very emotional.
It is emotional,
but as it should be. Good things should be emotional.
Sure.
But anyway, digression. But
no, thanks. I mean, it brings a tear to my eye. I don't care who they are. When they start to get it, when the lights go off, the bells go off, their understanding is like, oh my gosh, I do not have to continue down this particular path where I have no control. I'm a debt slave. I'm obligated to everybody else. And at the end of the day, and I know this is talking about debt, but we're talking about debt payments and debt service, and where does that money come from? That money comes from, the income that you earn or the value that you create, and you're literally exchanging your time, your effort, your experience, your knowledge to create this value, income, right? And then you're taking that from your family or vacations or whatever. So this income is really just an exchange of who you are and what you can do, right? And that has an incredible amount of value. And then to just value other people's money above yours is extremely perverse. It is perverse. And then what's even worse than that, though, here we all walk around and think that this is normal.
Right.
I mean,
duh. How else would you buy a house? Go get your 30-year note. Interest rates are low. Go get you a mortgage.
Yeah.
You'll build equity. It's better than rent. I mean, the whole conventional thing. Yeah. The finger wagging from the brother-in-law or the uncle or whomever. Interest rates are low, and I'll send you the contact information from my loan officer at the mortgage lender. It's like, people do it with good intentions. I'm not saying that. Like I always say, assume angelic intentions, but and I'm sure most of the time it is. Right, we're trying to help people with what we know, that kind of thing. It just so happens that what most people know, and when it comes to money, again, compared to what you can do with the infinite banking concept, is inferior. So,
that's on the debt level. We can, even Nelson, he talked about using other people's money, being a real estate investor, raw land. He liked timber because of his forestry background. Mm-hmm. And so that's been in the real estate business forever, leveraging other people's money.
Yeah.
Right. OPM. So.
And it's whispered like it's a secret. Oh, you should use other people's money.
Yeah.
Like, that's the insider secret. Make sure that other people have the ability to take everything you own. That's the good thing to do.
Oh, no. You mean when you sign that dotted line, you're collateralizing everything that you own?
Absolutely.
Right. Well, if you look at borrowed money, right, capital, that you're going to take and invest in a deal, real estate deal in my example, the capital is just an expense of the deal. The cost of capital, the interest is just an expense to the deal. So why not go do the deal, get the profits, and pay the third-party lender that cost of capital? Well, that's beautiful, and that's what all the real estate gurus talk about, right? No money investing, no money, or leverage your self-directed IRA or their new solo 401k or whatever. They don't really get much past the idea or the fact that there is never a problem until there's a problem. Nelson didn't have a single problem in the world until something occurred outside of his control by the bankers, right, raising the interest rates. So what happens when it goes bad? There's never a problem till there's a problem. But then when there's a problem and you're over leveraged with other people's money, and you collateralize that.
If you're Dave, you go bankrupt.
Oh, hey, now.
That's a historical fact. He tells people, I'm not throwing nobody under the bus. The people like it. There's others, internet marketers, who have had unfortunate financial experiences because of the lack of control over the banking function. Mm-hmm. That's a fact. I'm not being hard on nobody. That's just the truth. I mean, they would,
Well,
I find this information from their blogs.
So. Well, when it goes bad, you control all of a sudden becomes extremely important, or the lack thereof.
Mm-hmm.
All right.
Yeah. So. And what's that worth? What's it worth when everybody else is in these liquidity traps, right? Banks won't lend It's really not that banks. I mean, they will lend. They're just not lending to you.
Exactly.
Right? They'll lend to Wall Street all day, but you're not one of the preferred clients, a primary dealer at the Federal Reserve, right? So it's really not. It's not a liquidity trap for everyone. It's that you are not at the front of their line.
Yeah, it's a liquidity trap set for you.
Exactly.
And then wait a minute, and they financed the whole deal to begin with. Yeah. Right, and then they created the liquidity trap. Oh my gosh! And then there are your assets going to zero that they'll happily separate you from, repackage them, and do it all again. 6,000 years of recorded history. Okay, so there's that. I see a lot too in the infinite banking world that the the idea, the sales, and just let me say that in the life insurance industry. The life insurance companies and the agents and the advisors, they all want to write. I mean, we want to write life insurance, whatever. To see the infinite banking concept classified as a marketing idea or a sales tool or a sales gimmick, peeves me to no end. Mm-hmm. And so you have out there in the big wide world all this debt recapture, debt. Get out of debt, get out of debt, get out of debt. No, here's how you can do it with infinite banking concept. I know where you're
going with this, yeah.
I mean, it's like default to you didn't create all that outstanding debt because you had uber discipline. Mm-hmm. And so for an individual, an organization, a company, an agency or whatever to go create this whole sales solution to use the infinite banking concept to get out of debt and create all of these third-party calculators or their own calculators or whatever, and it's all predicated on the idea that there's so much smoke and mirrors, and this is just my opinion from the outside looking in, that you're confused, but oh my gosh, those graphs and those numbers are pretty, and you're going to keep buying life insurance and keep buying life insurance and keep buying life insurance, or all of your cash flow turns into life insurance premium. I think that's kind of problematic, and so, but yet again, that is the thinking, right, of this idea is a gimmick, and it's all about numbers, and you can just run all of your debt or all of your income through an infinite banking policy and come out, on top of the hill, king of the mountain.
Yeah, get something for nothing. Just put money in this pocket instead of that pocket and end up with more.
When the bottom line is life insurance, properly designed life insurance, issued by a mutual company that participates in the dividend, is one of the best places in the world to put money. All right, and then you're properly classifying your capital. Right.
Yeah, prioritizing your capital, the degree of control that you can exercise over financial value. You're putting that first. And it's like, what else would you do? So I have clients who
live free and independent.
Yeah, right. That, oh my God. So I'm, my generation is out of college, right? Just out of college, huge amounts of student loan debt.
Oh my
right?
gosh.
Hundreds of thousands, like plural, hundreds of thousands in student loan debt, right?
Individually.
Yeah.
Yeah.
Oh, individually. Yeah.
Yeah.
Yeah. And it's like, okay, that's the hand that we're dealing with, that's what we have. But the bottom line is, if somebody does infinite banking and really adopts it, like makes the full paradigm shift, participates fully, understands the book, knows what's going on,
yeah,
and conforms their behavior accordingly, right? Pays substantial premium, builds cash value, right? That individual will clear away that third-party debt much quicker than somebody otherwise would. And so I think of the mortgage example. We swallow it whole that the way to buy a house is to take a 30-year note where by volume, your finance and interest charges will be about 45, 55, whatever % of your by volume of the total amount of money that you're going to spend, right? And it's like, oh yeah, but it's okay. Interest rates are low.
Swallowing whole, that's like swallowing a camel, straining at the gnats.
Absolutely.
It's like, well, what's the interest rate on that policy? The insurance company is going to charge me interest. Yeah. Look, if they're going to charge me 5, 6, 7, 8, 9, whatever it is, every company's different. I can get capital at 3% or 3.4 or 3.89. This is August, so I don't know what 30-year mortgages are. Probably just under 4. Mm-hmm. right? So why would I borrow capital at 5 or anything above 4? Why would I do that? But in the infinite banking world, or in this footprint, you see an awful lot.
Yeah.
And one thing that I want to say is that almost boils over into another conversation along the lines of, well, I should just capitalize my policies and wait for opportunities, is one side. The opposite would be, I want to take 100% of my available cash value, and I want to collateralize that and take advantage and take over every third-party debt that I have. Like one way is right and the other way is wrong. Right? And so
that's the perception.
Yes, that's the perception. And at the end of the day, the banker can do whatever he wants. He who has the gold makes the rules.
Yes.
Right. And this concept, this idea that you can become your own banker, I mean, think about that. You can become your own banker. You can do whatever it is you want to do. You should know the ramifications of whatever it is you do.
Right.
Right. And how it affects your policies, how it affects your overall financial, picture. But I know personally, I have financed investment, real estate and down payments, and I've taken over notes, and unless I just want to jump through the third-party lenders hoops, right, coughing up 2 years tax returns, pro formas, and get my CPA to sign off on it, and his signature falls right underneath the statement that says,
free, right?
Oh yeah, right. After the cost, his signature goes right underneath below the statement that says all of these figures have been provided by the client, and I'm not vouching for them. In layman's terms, that's my interpretation, right?
Yeah.
No, that's in fact, that's what it is. And so you can do whatever you want. What is that worth?
Yes.
Now let's say that I take over a note, a debt obligation, whatever it is. What's that worth? Where can I put that on an illustration? How do I assign a value to that? Right. Or let's say that I don't take over a note. Let's say that I use the third-party lender's money at whatever rate. Right. And if you're hung up on rates, there's more you should learn, because it's not about rates. It's about velocity. It's about control. It's about use. But so what, I'm using the third-party lender's money. Now, I'm just being part of the problem.
Right.
If I go down to the bank and the money, the digits didn't exist, the entries didn't exist until I put my John Henry on there, then they create money out of thin air, which is beyond evil, because then they're charging interest on money that didn't exist, and my signature is obligating me, everything that I've created, to collateralize, and whatever I'm purchasing is going to be collateral, and then the payments are coming from my future production. It's like, oh my God, the construct is beyond evil.
Yeah.
Okay, but let's say I chose to do that for whatever reason. And, we can sell ourselves anything between here and the front door.
Sure.
Right? Okay. If I were to do that, and I have done that, you can bet I have enough cash value available to send that banker packing.
Yeah.
If I got mad, or he showed up and tried to repossess something or whatever.
Or the bank gets bought out and new bank calls the notes due and all that.
What? You mean notes are callable? We've talked about this, right? You mean the FDIC stepping in and reclassifying notes? You were an A client until the reclassification, and now you're a C? Yeah. I mean, that's almost like a margin account, right? I'm borrowing money against the portfolio. The stock value goes down. There's a margin call. I got to sell stocks at a lower value to cover the margin call. I mean, who's controlling that? Anyway, my point being, the banker can do whatever he wants.
Yeah.
Right. Whatever they would like to do, and control is extremely important and valuable, especially when things go wrong. And you can't put that on a life insurance illustration, which we've talked a lot about in the past.
Right.
Life insurance illustrations.
And it's something that you can't really, I compare a lot of IBC to riding a bike. Like if you've never ridden a bike before, it looks like, how would you ever do that? Right. It doesn't make sense until you do it. Mm-hmm. And then it's like, oh, it's like riding a bike. Right.
Yeah.
And so once you're really in it and you experience the feeling of, well, I've got this outstanding, pick a number. I owe $10,000 to whoever, Department of Education or whomever your student loan, education loan servicer it might be. Pick any kind of debt, right? Just using the $10,000 student loan example here. So assume that you owe $10,000 but you've got sufficient cash value in your policy such that you could take a policy loan and wipe that out, right? Well, maybe you want to do that, or maybe you want to buy a new piece of equipment for your business. Okay, well now you have the ability to choose which one you want to do.
That can increase your profits.
It's not like I need to be under the gun constantly, pay off this debt, mm-hmm. and where we're issuing like a moral judgment about your character if you're not prioritizing payment of debt, right? So there's the internet personalities who part of their shtick is to make you feel bad because you're not eating beans and rice and choosing to pay off your student loan debt or whatever other debt might be outstanding, right?
Well, just save up enough money to go pay for college cash, okay? And tell me how long that's going to take.
Right.
Yeah, no.
So the ability to be in a position where you get to decide, no, I'm going to pay this now, or that can wait because something else is more important right now. I'm going to prioritize that, and no one's going to judge me because it's my money. I've got this policy, or I've got contractual authority over this value. What? We've beaten the daylights out of illustrations, but that is not on the illustration.
Look, you're going to be judged anyway if you're putting your capital in dividend-paying whole life insurance. So,
yeah, there's going to be judgment one way or the other.
I talk about quite often. Let's just look at a timeline from now into the future. Mm-hmm. Okay, and I have a tremendous amount of debt, and I'm going to take all of my cash flows, everything. I'm going to scrimp and save, and there's nothing wrong with discipline and living within your means. I mean, that's vitally important. Mm-hmm. And I'm going to pay that debt off. Well, I don't care, pick an age. I'm 25, I'm 30, I'm 35, whatever it is, and I'm going to spend the next 10, 15, 30 years getting out of debt, whatever it is. And if I accelerate that, I'm going to get out of debt maybe in 7 or 8 years, okay? And then, once I'm out of debt, then I can properly prioritize my capital. I can start saving money. Woo-hoo!
Right. You'll get to it in 30 years.
Or 7 or 8 if I'm really ninja-like.
Sure.
Okay. Well, can you fund a policy, pay premiums to a policy, properly structured, and then leverage that cash value and accelerate the debt repayment? Yes, you can. But let's say that it takes you, for this example, let's say it takes you 10 years to get out of debt because you're uber focused, ninja-like, and everything additional that you can possibly do is throwing money to the debt. Then you can start saving money. So the first part of this timeline that I'm talking about is 10 years you're out of debt. Now you can spend the next 10 years accumulating capital, right? When you put a life insurance policy in the mix of that, but up front, you pay premium and then put the available cash values to work through leverage, collateralizing, borrowing against that policy to accelerate getting out of debt. Yes, and let's say that it takes you 12 years to get out of debt, right? Mm-hmm. And have the policy loans repaid. I'm adding a couple of years to the 10-year in my conversation here. But now we're spending the next time period accumulating capital. I'm going to win hands down every time if I use a life insurance policy up front.
Yeah.
Every time. Because now I have a 10, 11-year-old policy, and they're phenomenal. The numbers, the action of the numbers, the relationship between the premium, the cash value, the death benefit, the dividends, all of it become staggering over time. So it's almost like I'm stacking time. Right? So that's a legitimate ability that you have. Is that the only reason why you should, buy life insurance and pay high premiums? No. Nelson was paying $18,000 a year in life insurance premium in 1980. Who do you know today that pays $18,000 in life insurance premium? And if I can continue for a moment, those policies did not have a paid up additions rider to supercharge the policy cash values. He started paying for life insurance at his age of 13 years old. All right, so he's born in 1931. All right, here we go forward to 1980. He's about 50-ish. All right, he'd been paying $18,000 a year in life insurance premium. Most of those policies were typically just typical whole life insurance, no cash value for the first 2 years. You might go cash on cash, cumulative premium, cash value in the 12th to 18th year. And then today, people have a hard time seeing the value of cash on cash and premium equalization. And I know I don't want to run on and on about this in life insurance illustrations, but because we talk about it in life insurance illustrations that we've beat to death several times, but I can't wait to beat it to death because you can't almost say it enough. The life insurance, you live or die by a life insurance illustration, and you're just creating a train wreck and disappointment, in my opinion. Does that mean you shouldn't know what you're doing or how your policy is going to function? Absolutely. And you should also know how your actions are going to affect that policy.
Yeah.
Okay. I digress a little. I'm just saying, can you do this? Get out of debt with life insurance up front of the time period of getting out of debt and then accumulating capital, and you come out ahead every time. But now we're talking about an extended time period, right? Getting out of debt and then accumulating capital, and it takes an uber lot of discipline to go through there.
Oh yeah. And I have people who do have substantial outstanding debt with third-party lenders, student loans, mortgage, what have you, and they're in force. These are people who have read the book, the application's been done, they've got through underwriting, they're paying premium, they're practicing the infinite banking concept, still calling and saying, I'm getting beat up by whomever, giving me a hard time for why in the world would you be spending so much of your income on life insurance when you've got this massive outstanding debt? And usually it's from the family. It's from the people who love you, who are close to you, who don't understand, and they really do honestly and truly want the best for you, and they are confused. And to the point where they think that you are misguided and consequently hurting yourself by not following what they believe to be the superior conventional advice. And so we've got to walk back through it.
Like they are. They're following conventional advice, and it's working so well for them that their children
well, that's what it is. They need validation, because if they're doing it and other people aren't, then, well, why? I mean, especially if you don't understand, right? If there's confusion and mystery, then there's going to be hostility, right? If it's unclear, if there's a lack of clarity, it's so easy to get angry and to start wondering what and then the agent.
No, I'm going to question your character quickly.
Absolutely.
What are you doing?
Yeah. What is this guy doing? Trying to sell you? Of course, he's just a life insurance agent, right? So he's probably just trying to sell you something. Fly by night, never see him again kind of individual, which the industry earned that reputation. But
with many other industries.
Absolutely. The salesman, right? Oh, sales. But they get it from the people closest to them. And so even the people who are doing this, who are over the long run going to be far better off, since they have prioritized their capital, they've chosen to form and accumulate capital that's under their ownership and control, they're going to be far better off. But even those individuals still need reassurance and confirmation and affirmation, because it's like Nelson always used to talk about, the noise. The financial noise is everywhere, and we're surrounded by it. We don't even realize it until you start saying, these heretical things of, I'm going to buy a whole lot of life insurance, which has little death benefit as possible.
We're surrounded by it. We're steeped in it. We're baked in it. I mean, it is everywhere you look, everywhere you turn, the noise is constructed, and you're going against the noise, against the grain, in spite of the noise, in spite of swimming upstream,
opting out.
that is the infinite banking concept. And I don't care if you're talking about student loans. I don't care if you're talking about mortgage loans. I don't care what you're talking about. This is going upstream, right? Just the idea of paying high premium, high cash value, owning high cash value life insurance, and then using that. Now, if you just back up a minute, if I have access to my capital, there's a startup cost. Right, you can't get around it. I can't get around it. No, the agent is not paid all of that money that you don't have access to in the first year or two. It actually costs life insurance companies to put these policies in force, and the agent is only part of that cost. Okay, but if I can put money somewhere and I have access to it, and I'm going to get a death benefit, and it's going to grow forever, the rest of my life, the dividends are going to increase. Not guaranteed. Dividends are not guaranteed, but I can expect some kind of a dividend from a 100-year-old company that's never failed to pay a dividend, that is run honestly, openly, straightforward, well run, and I'm going to have access to more and more of the capital that I put in, and then because I have that contractual access, right, the contractual right to that money, and I'm paying attention going along in life, it puts me in a position where either I can put that capital to work through collateralization, borrowing against cash value, taking advantage of opportunities, or maybe I'm just becoming my own banker and getting rid of the 10, 14, 20, 29% interest rate credit cards. Or I see lines of credit today, 2019, this is August, at 10, 11, 12, 14% interest. Lines of credit. I mean, to established business professionals. And wait a minute, I can either become my own banker and just control the debt, right, while my net worth is increasing 24 hours a day, 365 days a year. The cash value increases today, Saturday. My cash value is going to go up today. It's going to go up tomorrow too when I'm in church. The markets are closed. Saturday and Sunday. I'm just saying. Tell me what's wrong with that. Oh yeah, it's life insurance. Yeah. Oh, okay. So if I graduate and there's a large net death benefit that's going to be paid to my people, income tax free. Tell me again what was wrong with that. Oh, and then wait.
I imagine they're going to stop wondering why you paid all those premiums to get that death benefit.
They're probably going to say, "Dang, I thought Dad had a lot more." I don't know.
All right. So bottom line, you do not need to wait until other debts paid off. IBC is open to anybody who's willing to do it. And I tell people all that requires is you make more money than you spend, and that.
Wait a minute! Don't be so simple. I want a complex solution. Okay. Wait a minute. If you're going to wrap this up, let me say, can you do this? Right? Can you start a life insurance policy, collateralize that to put in the mix of getting out of debt? And there's a correct way to get out of debt, smallest debts first, and the interest rate is part of that, but it's really the cash flow, the debt service. So it's a balance of the account that's owed, the debt, and the cash flow that's servicing that debt, right? So you prioritize what debts to get out of first, and then if you're doing that with a life insurance policy, right, collateralizing the cash value, you're going to wind up with an outstanding loan balance of the life insurance policy. Isn't that just the last one you pay off?
Yeah.
Right. It's really simple. What scares me, what raises my eyebrow, is the discipline that it takes to control your cash flows in your life while we're all swimming upstream and we're surrounded in this noise of get out of debt, life insurance is bad, put your money into the market, and just a conventional financial noise.
Yeah.
But can it be done? Yes, it can be done. Does that mean everybody should do that? You're having a hard time saying that.
Just because I know everybody can. It's available. It's possible. It's just a matter of changing how you think.
I love that. It is possible, and everybody can.
All right. You got anything else?
Yeah. No, I do. How long are we going here? Can we go over? I mean, is somebody?
We're already over, but yeah, go on.
All right, but there's
no rules here.
Oh, perfect. I like it. Okay. I mean, if we talk about debt and discipline, and the individual, we're talking about, personal debt, really. But let's just go to the public debt, the political and the government debt. Same situation. They have no discipline, but they don't even create wealth or value, right? And then they're promising all of these great things and like pensions, and they're all imploding, right? The same thing is going on at the political level and the governmental level, at every level. City, county, state, federal. Just don't be like them. Right, I just want to throw in.
Even worse, you got to work for it. They can just print it.
No question, and benefit from that, right? It's like, okay, I just wanted to throw that in there.
No, that's good. Absolutely. All right, that's all for me. Thanks for listening.
Well, they're wrapping me up, so I got to go. Thank you. I appreciate you. Can't wait to talk again.